And our job is to look forward the next 2 years, 3 years, 5 years, and say, is this current state of affairs going to be permanent or temporary? Well, the history of economies is the business cycle goes up and down. It's cyclical. So, therefore, we're at the cheap levels, we're kind of at key trend lines, and almost every time we get here, the crypto market 10 or 20 X's from here. So my view is that we're still paying for the effects of COVID that cause all sorts of problems, like nobody could manufacture anything, nobody could ship anything, planes couldn't go anywhere. And so as COVID started to ease, people came back out of their houses, back into the office, back to consuming things, and there were no goods to be bought because all the shelves were empty because nothing got manufactured. So that caused this huge rise in inflation. The central banks think, oh my God, it's inflation, because inflation's pretty bad because most people's wages haven't gone up as much as prices have, so everyone feels poorer. So the central banks think, God, we need to do something about this. The economy is actually falling off a cliff because they probably over-tightened. So even though we kind of know things are bad, the forward-looking stuff that I look at using my kind of macro framework suggests things are going to get really quite ugly over the next 6 to 9 months. So what the Federal Reserve are doing when they raise interest rates is they're taking what's known as liquidity out of the system. So what they're saying to banks and others is, we're going to allow you to have less money to use around the system. So that means it's harder for anybody to borrow money. It's got more expensive. Your mortgage has gone up. Your rent's gone up. So everybody stops spending and the economy slows down. And that brings down inflation because there's less demand for goods. Oil to the price of commodities has collapsed. The price of cryptocurrencies has collapsed. So it's been a really, really tough 9 months in financial markets and for people's savings and investments and potentially for their jobs too. So crypto is a function of two things: technological adoption and the macro, the liquidity that the central banks are providing. Those two things are the key drivers. So if you zoom out of a log chart of crypto that everybody always tells you to do, you can basically see things like Bitcoin go up, just up over time, and up a lot. But it's very volatile. You get these kind of big ups and downs. So the question is what drives the big up, and then what drives the ups and downs? The big up is driven by the adoption of technology. There's now 300 million people using cryptocurrencies or investing in cryptocurrencies. It's growing at about 100% a year or so. It's the fastest adoption of any technology the world has ever seen. So people are adopting this twice the speed of the internet. That's why it's been so profitable, but it's also very volatile. And it's very volatile because when the central banks remove liquidity, which they've done in 2013, 2015, and various other points, cryptocurrency collapses because there's less money around for people. Most investors in crypto are actually retail investors, and they dollar cost average. So they put in some of their paycheck every month. Now, the issue is if your paycheck's gone down, in purchasing power terms, you have less money to invest. So suddenly, cryptocurrencies are less active, the networks are less active, and the price has gone down. So does that change the long-term picture of the adoption of blockchain technology? Well, when you look at it and you see everybody from Nike to Gucci to Ticketmaster, you name it, all using blockchain technology, it's not going away. We're just in this period where it looks pretty ugly and feels pretty ugly. Big financial market participants that we've been waiting for to enter the market, some of them have. So these are the big pension funds and hedge funds and others. They're also struggling from lack of liquidity because their portfolios are going down from what the Federal Reserve are doing, so they have less money to put into crypto. So I spend a lot of time speaking to these big institutions, and they're all ready to get involved, but they just don't have the cash right now, much like we don't have the cash because everybody's feeling the pinch. It's not going to drive up the price. But once this situation eases, it'll start driving up the price. Now, there's another piece of magic that happens with crypto, is crypto doesn't do well in inflation because of the reasons I said. But when the central banks start printing more dollars or euros or pounds or yen or whatever it is, that's called debasement of the currency, quantitative easing. And that is when crypto does really well. So one of the reasons I've been very closely following the prices in crypto recently is because as we start getting a worse and worse economy, we know eventually rate rises will give way to rate cuts. Quantitative tightening will go to quantitative easing, and those conditions are literally perfect for cryptocurrencies. So there's two reasons. One, I think it resonates with people that it is a different answer to the financial mess that we live in. This hugely indebted economies driven by central banks and government policies, and people want a different way out. So it resonates as a narrative to people. What's super powerful about crypto versus almost anything else is the fact of how it works with behavioral economics, because token systems are incentive systems by nature. So to explain it to you on a simpler level, Facebook is a viral set of products, whether it's Instagram, Facebook, WhatsApp. But we as users get to use those things, but we don't get any rewards except connecting with our friends or whatever, and the shareholders got rich. But with crypto, it's like we'd all been given Facebook shares. So imagine if every time you logged into Facebook or used Facebook, you got shares. So if you own part of the network, well, what are you going to do? You're going to tell everybody about it, which is why you get this kind of weird world of everybody shilling cryptos, because it increases the size of the network and therefore the value goes up. So it's viral by nature. It's kind of designed to be viral. So it's very difficult to stop because of the human psyche behind it. So crypto breaks down to a whole bunch of different things. So you've got at one level with Bitcoin, which is like an asset that the central banks and the governments can't mess around with. Okay, so therefore over time it should maintain its value. Now it's very volatile still because it's still early in its adoption. But it was the advent of Ethereum and the smart contract that was the big game changer. Because almost everything we do, including me coming on this podcast, is a contract. Now those can go on blockchain and be recorded. So before, if you buy a car, you have to go to the centre and register it and do all of this stuff. It's a pain in the arse. But what happens is on blockchain, it can be authenticated by a distributed network of people, which means it's more secure in terms of who confirms that contract exists, and therefore it can be policed. This launches things like NFTs, which are non-fungible contracts, which are essentially non-fungible tokens, which are essentially smart contracts. Well, there's a piece of magic, and I alluded to it earlier. We know that the adoption is going up, and the adoption of a network drives up price. It's called Metcalfe's law. So here we are at the most oversold levels almost in history of crypto. Yes, the price move has not been as big as it was in earlier stages, but the levels of how oversold it is are enormous. And our job is to look forward the next 2 years, 3 years, 5 years, and say, is this current state of affairs going to be permanent or temporary? Well, the history of economies is the business cycle goes up and down. It's cyclical. So therefore, with the cheap levels, we're kind of at key trend lines, and almost every time we get here, the crypto market 10 or 20 X's from here. Now, that's not a guarantee that it does it next time. So your risk reward is highly favorable. And you've got the shifting macro where we're going from maximum pain in the economy to starting to see the central banks change their course and start adding liquidity back because they've broken the economy. So therefore, you really should be focused when everybody's scared and everybody's puking their crypto, their ETH and Bitcoin. You should be thinking, now's the time to accumulate it. Because when you've got an asset that trends so strongly and is so volatile, these sell-offs are your friend, unless something fundamentally changes with the story. And we don't see that. We don't see it. It's not been banned by every government. People haven't walked away from it. It's the same with the personal computer. The same with Amazon. Amazon, when it went public, fell 96%. And then it went up and then fell at 80% and then down and then up and down. And it had the same adoption curve as people adopted the Amazon network. And really, the only person who ever managed to hold on to it was Jeff Bezos. Because everybody else panicked out all of the time. And he became the richest man in the world. Fine. I think it's really hard because it's now so big and it's distributed, so therefore it's decentralized. So we saw that China bans it, market goes down a bit, then nothing happens. India bans it, unbans it, bans it again, nothing really happens. So it's actually difficult to think what is the existential threat now. The one threat people say is, well, if the global internet is turned off. But again, that's a distributed network, and with Elon Musk's Starlink, it's actually harder to do. Don't see the existential threat. You can have threats, like the US regulates it, tells everybody Bitcoin is bad, you're not allowed to own it, much like they banned gold in the 1930s. It didn't stop gold being an asset. It just changes where it's held and by whom. So I don't see the big existential threat. The better is a subjective thing. It depends what you want to use it for. So Bitcoin not being the fastest, cheapest is not a problem because it's more decentralized. So people want that element. So different people want different elements. All I look at is break it down. What drives price? Price is driven by Metcalfe's law. Metcalfe's law is how you value a network. It's the number of people on the network and the number of connections between them. So why I got very bullish on Ethereum is I could see that people were building a lot on Ethereum and the Ethereum user base was growing fast as a rate of change. It was earlier in its adoption and therefore the price goes more exponential earlier on. Because when you go from one person to 50, that's a 50x increase. When you go from 50 to 100, it's a doubling. Right? So that's what drives the value of these things. So I was very, very bullish Ethereum, and I still am. It's still the majority of my investments. But Solana, I noticed that a fast blockchain is going to capture different use cases where we really need speed and cheapness. And Solana also has been focused on the kind of mass adoption stuff. So they got NFTs and they did quite well from NFTs. They're thinking of consumer adoption. Well, other chains like Avalanche might be looking at financial system adoption. So I think consumer adoption, because there's a lot of consumers out there, and I think that if the trend of adoption for crypto continues as it is, we'll have 1 billion users by 2024, and we'll have 3 billion users by the end of the decade, 3 or 4 billion users. So that means that chains like Solana should do well if they're focusing on that part of the market. If I'm right, and it's an if, then we should see it outperform because it's earlier in adoption. So it's going from the 1 to 50 and not the 50 to 100. And it should see a huge growth in its network.